Hi everyone, this is Daniel with another video from warm sunny Ireland. Always warm, always sunny, sometimes Ireland. Today is November 12th, 2022. Now let's jump into the video. What is a value investor? 1. Be an owner of a business, not a paper shuffler. 2. Always have a huge margin of safety. 3. Think everyone else is different. Lilu mentions Mr. Market analogy, which is Mr. Market is an imaginary investor devised by Benjamin Graham and introduced in his 1949 book, The Intelligent Investor. In the book, Mr. Market is a hypothetical investor who is driven by panic, euphoria, and apathy on any given day and approaches his investing as a reaction to his mood, rather than through fundamental or technical analysis. The stock market is not created for you, the value investor. It's created for the 95% of all the other people, and that's really where your opportunity and challenge lay. This is a fundamental question and is highlighted throughout this talk. So again, ask yourself, are you part of the 5% extreme value investors, or are you part of the 95% of the majority? You need to figure this out. You want to be like Warren Buffett, Charlie Munger, and Lilu. It is no easy task, but that is what we all must strive for. Well, all of the 5%. The market is created for people who think short term, think Wall Street analysts, short sellers, and traders. You really need to understand who you are, because you will be tested through market downturns, recessions, and what if a company you just bought fell 50, 60, 70%? Do you sell? What will you do when all the smart money is laughing at you? They are making money and you are losing money. You need to be confident in your analysis and confident being in the minority. Most of the time will be spent as an academic researcher or like journalist. You must have a very curious mind. If you are not curious, you will not do the required work to be in the 5%, and that is where the real money is found. It will not be easy, it will be emotionally difficult. Investing, really, the more you know, the better off you are as an investor. This can be clearly seen from Warren Buffett and Charlie Munger, who spend 80% of their day reading and thinking. You have to be a learning machine. Ask yourself important questions. Lilu asked the following questions. Is the business cheap? Is the business a good business? Can the management be trusted, either because they are good or because the eternal checks are sufficient? What else is missing? Go through all checklists and make sure you feel comfortable before you invest. Lilu mentions that he became hooked on Valueline while a student and that he reads every single Valueline page by page. He loves looking at all companies. The good thing about Valueline is that you can go back 10 to 15 years on a specific company. He always checks the new low list on Valueline. Timberland Case Study. So Lilu goes back until September 1998, when he came across Timberland on Valueline. The stock was trading around $28 a share. Lilu's sheet says $46, which is wrong. So he calls that $28 to $30 a share. He asks, what is the first thing that jumps at you? If you're an investor, you don't care where it traded to before. All you care about is that the valuation. If the valuation doesn't fit, that's it. He asks, when you see book value, you want to say, what's in the book? How much is the book? It is fine to use approximate calculations, as he is doing this all in his head within a minute. So call it 28, and then you've got 11.5 million shares roughly outstanding. So multiply 28 by 11.5, which gives you 322 million, which gives 322 million, but take 300 million for approximate. Working capital is almost 300 million. Liquid assets is 200 million. Working capital 275 million. Book value 300 million. 100 million cash end of third quarter. 100 million in fixed assets, and if you do a little more study, you're going to see there's entirety building real estate basically. So 300 million. 100 million is in real estate, so you got a pretty decent protection on the downside. Q3, in retail, what happens? This is where your quick encyclopedic knowledge helps you. Usually there is a huge buildup of inventory in Q3. Check the previous year's Q3 to find out what is normal. So what do we know about the earnings, the cash flows, and the ones you want to really pay most attention is pre-tax and pre-interest earnings unleveraged. You want to compare that with unleveraged capital that is needed in the business against your sense of what kind of business you're evaluating. How much are you making? 13% roughly operating margins of 800, so you get roughly between 104 and 110.5 million. What is your deployed capital? How much capital is deployed in the business? About say 200 million in liquid assets, then 100 million in buildings, and then 200 million in liquid. Has probably 100 million cash. So you would have roughly 200 million deployed capital and about returns of 110 million. Your return on your deployed capital is around 50% at that point, so that's not a bad business. The business was trading right around the book value. Why did this whole business fall apart? This all happened at the height of the Asian financial crisis. Timberland's competitors, especially Nike and Reebok, see their sales, especially in Asia, falling off a cliff as well. Most people recognize Timberland as a brand, right? Not a bad name. Lulu again highlights that always think yourself as a business owner in these situations. What are other people thinking about this? You may not really listen to the advice, but you want to really know what other people are looking at, so you check to see whether there's any analyst report. Turns out there's no analyst report. The fact that there is no analyst report is a good thing for retail investors. The business has been growing. The profitability has improved dramatically over the recent years. The company is family owned. They own 40% of it. How much vote do they control? They have a 98% vote basically. There are a whole lot of shareholder lawsuits, so immediately that if you don't know anything about the business, you would be worried. If you're a part of the 95% of the other investor, what conclusion would you draw? You would probably think the business is not worth the effort. Maybe the management are milking the books. All this comes down to one complaint. It's just multiple filings that you know somebody really say, well, they used to provide some guidance and they didn't deliver, and the investor get pissed off. If you're a part of the 5%, download every single piece of the document of the court cases, every single case, and read every page. You have to be so curious. Ask yourself what's happening. This doesn't add up, and you have to dig every single thing up. Read everything. From reading everything, you find then the owner too gets pissed off. You know vividly. See his defense. You can get a sense of his personality by reading those documents. Now you see that maybe they are not crooks, but are they good managers? How do we know they are decent people? What do you do to find out? The point is that you got to be really curious. I always view this job as investigative journalist. Most people who have built businesses also have big personalities, have a history you can go to audit, have left a trail of evidence of what kind of person they are and what they have done, how they deal with different situations. It is not that difficult. If you're a part of the 5%, you need to go to this level of detail. That's what you do. You go to see their community. You go to the church or synagogues. You go visit everybody and you introduce yourself to all their friends and families and neighbors. Don't just call them, go there. Spend a few weeks there. It's worth it. What does his neighbors and friends say about him that tells you more about his personality? And you want to find the family dynamics. This fellow actually only graduated high school, never really went to college, relatively simple guy. But more interesting, he has a son who actually went to business school as well, was actually my age at the time, already assumed to be CEO of the company. So I did all the things I suggest to all of you. I did further research and I found out all the boards the father and son are on. One of the boards the son is on is actually run by a friend of mine, so I invite myself to be on the board. Joins board and becomes close friends with the son, and then I really know what is going on in that family. Turns out this is one of the most admirable families he has ever met. They are people of the highest integrity. Did I miss anything? Probably not. So everything considered, there is virtually no downside. You're trading it roughly 5 times, and the next thing I did is actually went to all the different stores to see why in the last few years the margin improved substantially. It turns out there was a fad going on, especially in the inner cities, that all the little kids wanted the Timberland shoes and jeans. One of the store managers said that they couldn't get enough stock. How much of their international business is actually in shoes in Asia? Less than 10. What do they make out of that less than 10? 10% out of 10% of the 27%. So you calculate all day, you say that all of them are gone, you're losing money. So what it reduces your earnings by less than 5%. How much do you want to buy? So I put a shitload of my money in it. Anybody know what happens afterwards? Well, the next 2 years, Timberland went up 7 times, 7x, and the truth of the matter is you still did not have any risk. It's not like you're riding some technology company. After they doubled, tripled, you expose yourself to a huge amount of attacks. It was never more than 15%, 15 times earnings. I think we learn a great deal from Lilu from this Columbia lecture. I'm very glad that this video got uploaded to YouTube. It is great to see a super investor run through a company on how he evaluates a company. So much to be taken from this video. I hope you like my walkthrough. Thanks for listening.